Okay, so today we are going to learn about directional bias and time frame coordination. So directional bias and time frame coordination. So this is the very, very important topic to understand, because this is going to help you to analyze the market and taking entries also. So what do we mean by directional bias? So directional bias is simply the movement of price in relation to time. So we know that in this market we have what? We have time. Some people start trading with 4-hour and some people daily, but how do we coordinate these time frames? So we have people when, for example, let's say this is the area of liquidity of monthly. So someone can see the price in the same, for example, this is GBP USD. So in the same GBP USD, someone can see the prices is bullish, meaning that it provided him or her an area of liquidity, a buying side area of liquidity like this. But somebody else can see the price in the bearish sense. Maybe, for example, this is weekly. So how do we coordinate this time frame in order to align with our decisions in the market? That's why we are going to learn about directional bias and time frame coordinations.
Okay, sir.
So in order now to know how to align yourself with in the price in relation to the time, there is a so-called time frame coordination. Now, time frame coordination is simply the time frame that we have in the market. How do we coordinate them? So we have two types of time frame coordination. We have a constant time frame, and we have situational time frames. I'm sorry.
Assalamu alaikum wa rahmatullahi wa barakatuh. Taasisi ya Islamic Foundation inawatangazia
hello, I'm sorry, we have some.
Okay, sir, no problem.
Okay, so let us continue. So, as I said, we have two types of coordinated time frame. We have what we call constant time frame, and also we have situational time. So in this in this constant time frame, we only have two time frames that are constant. I mean, we have monthly time frame and we have weekly time frame. So these are the constant time frame that we have. The rest from the weekly, from the monthly and weekly, from the daily to the lower time frame, those are the situational time frame. So,
Okay, sir.
so whenever you are in the daily, maybe you are in the 4 hour and the 1 hour, those are situational time frame. But sometimes daily and 4 hour or 30 minutes and 1 hour can be constant time frame. So we are going to see in which situation that we can use daily and other time frames as the constant time frame. So by knowing now the constant time frame and situation, we have also two series of time frame coordination. We cannot just jump from daily to going to 4 hour or 30 minutes. We have a proper series of time frame. So as I said, we have a monthly and a weekly as our constant time frame. So if you are in monthly coordinates with what time frame? Monthly coordinates with daily.
Yes, sir.
And then daily coordinate with 1 hour. 1 hour coordinates with 15 minutes.
3 minutes.
That's the series of monthly. But in the series of weekly coordinate with 4 hour.
Yes, sir.
4 hour coordinates with 30 minutes. And 30 minutes coordinates with 5 minutes.
5 minutes.
So these are what we call series of time frame. Now, we have other time frames now. This time frame, we call them universal time frame, meaning they can be used in both series. And those are 5 minutes, 3 minutes, and 1 minute. So let's say, for example, you find a formation maybe in 15 minutes, and still it offers you high risk. So from there, you are allowed to go to this universal time frame to refine it more, to get lower risk.
Okay, sir.
So these are the series of time frame. Now,
Okay, sir.
okay, so sometimes we find ourselves trading monthly as our as our constant time frame or weekly. But you know, we have different types of traders in the market. As you know, we have swing traders, we have intradays, or we have scalper. So each and every trader has its own time frame coordination to support his trading style. So for example, let me put this in this form. So we have swing traders, we have intradays, and we have scalpers. So both these traders, they have their own series of coordination. So for example, if you are a swing trader, if you're using a monthly coordination, a swing trader, meaning this is a trader who holds his positions for a long period of time. So for example, we can take an entry now and exit maybe over a week or a month. Sometimes can go even a year. Those are swing traders. So if you are using a coordination, a monthly coordination, meaning you will start analyzing the market in the monthly and find the break of market structure and a possible area of liquidity, meaning if the break provide the formations or what, and then you will go to daily. So daily will be your situational 1. And then you will go to 1 hour as your situational 2. And then you will go to 15 minutes as your entry point. If you're using a weekly, meaning you'll go to 4 hour, you'll go to 30, and then you'll go to 5 minutes. So 4 hour will be your situational 1. And 30 minutes will be your situational 2. And 5 minutes will be your entry point. But what if you are intraday? For example, I myself, I am an intraday trader. So what time frame do I use to support my trading style? So in an intraday, if I'm in the monthly coordination, meaning I will start with daily time frame. So daily time frame will be my constant time frame. My constant time frame. So
Okay, sir.
so 1 hour will be my situational 1. 15 minutes will be my situational 2. And 5 minutes, because in order for a coordination to complete, it must have at least 4 time frames, 4 different time frames. So we cannot just end in a 15 minutes. We have to add 1 in order to complete the coordination. So daily will be my constant. So if I'm using the weekly series, I will use 4 hour as my what? As my
As a
constant
time frame.
yeah, constant time frame. So this is 30 minutes will be my situational 1. 5 minutes will be my situational 2. And 3 minutes will be my entry point. But what if
Okay, sir.
what if I am a scalper, meaning I'm just entering the market, find my entry and exit in a few period of time, just taking short entries. So for a scalper, if you are using the monthly coordination, meaning you will start at 1 hour as your constant time frame. From here, you will find the break of structure and possible area of liquidities. And then 15 minutes will be your situation 1. 5 minutes will be your situation 2. And 3 minutes will be your entry. But if you are using a weekly coordination, meaning you will start in a 30 minutes as your constant. And then you go to 5, then 3, and 1 minute as your entry point.
Okay, sir.
So wherever you are entering in the market, you have to define yourself. And are you going to do intraday, or you're going to scalp, or you're going to swing? So if you are going to swing, you have to choose a series of time frame that you are going to use. Meaning if you choose weekly, meaning you refine the breaker structure in the weekly and possible area of liquidity, then you define them in the 4 hour. If you still have a long leak, huge risk, you refine it again in the 30 minutes. If you still have huge risks, then you refine it in the 5 minutes. And so on and so on. If you are intraday, meaning you will start with daily, or you will start in the 4 hour. And for me, I use mostly 4 hour time frame to find my entries. Yani, this is my favorite time frame coordination. I use mostly. I'm sorry, I don't know what happened.
Maybe a signal problem, I think, sir.
Yeah. Okay, so let's continue now. So, so that is how we use this time frame coordination. And remember, in the topic of liquidity engineering, I told you liquidity engineering, we call it liquidity engineering from 30 minutes. From 30 minutes to the lower time frames. But we take it as entry from 15 minutes to the lower time frame. So this, I remember I told you this. Now, why is this? It is because we don't take liquidity engineering as entry in the 30 minutes, because 30 minutes, sometimes we will use this 30 minutes as a constant time frame. As I told you there, we had, if you are a scalper, you may use 30 minutes as your constant time frame. So you cannot enter the market in the 30 minutes time frame. That is not possible. If you use a constant time frame, 30 minutes as the constant time frame, you cannot enter in the 30 minutes. Meaning you will define it in the 5, then in the 3, then in the 1. That's why we term liquidity engineering as entry from 15 minutes to the lower time frames. Because 30 minutes, we may use it as our constant time frame in some points. So that is all about time frame coordinations and yeah, and its series. So we have okay, so that so we have 2 types of buyers in the market now. So wherever you have, maybe this is the price was performing something like this, then the price changed the character here, and the price breaks again. So we have 2 types of buyers. So for example, let's say this is our break of structure. So we find maybe we have a formation inside here, meaning we will set our entries at this point. Now, there are 2 types of buyers. Number 1 is confirmation bias, and another one is aggressive bias. So all these are different. So for example, if you have this area of liquidity that you have refined it, and the price, you are waiting for the price to come here. If you are a confirmation bias, you are in the confirmation bias, meaning you will wait for the price to come to that area. Then after reaching that area, you will wait for the market to give you another break of structure, a change of character, sorry.
Okay.
You will wait for the market to give you a change of character and the break of structure. So from there, you enter now as a confirmation. So confirmation bias, meaning you wait for the price to enter the area of liquidity that you have marked, and then you wait for the change of character and the break of market structure. So why change of character and break of market structure? Sometimes price can give you a change of character and still breaks below. So it changed the character here, but the price also changed, shifted below. So in order to be sure that the market has changed the character, you have to wait for the market to change character and break the structure. So this is what we call a strong shift. So a strong shift is where the market changes the character and breaks structure. So if the market gives you this, so there now you are very sure now the market has changed the character. For example, here in this situation, if the market just if the market here if the market here reaches the area of liquidity here, remember this was also our area of liquidity. So price has changed the character here, but it may this was our area of liquidity where price break the structure here. So the market was supposed to come here and fill the liquidity, then move down. So how will you be sure that this area will be strong enough to raise the price? In order to be sure that this area has the strong features to raise the price, you have to wait for the market to change the character and break structure. Now from there you can enter in that break of structure, or sometimes if the market break the structure here, meaning you have this formation to enter, but sometimes the market may left some liquidities in this formation. So the market can come in here and move. You will see in some examples. So that is, so this is confirmation. So what about aggressive bias? Aggressive bias meaning you wait for the market. After the market gives you a break of structure here, you refine this area of liquidity to the lowest point, to the lowest possible area of liquidity. For example, if you find here the formation, or maybe a liquidity engineering, then you place your orders there and you wait for the market to tap, take the entries, then go. So you don't wait for confirmation. And most of the
Okay.
time, most of the time, I use aggressive buyers because there are we have advantages and disadvantages of this. If you are in aggressive buyers, the advantage is meaning you will have entries that that this confirmation buyers will never have.
Okay.
And the risk of it is so risky because sometimes the price may not respect that due to some reasons. Maybe the price acted in this in this area, and this area was strong enough to move the price down. Or sometimes the price may show you the break of structure, but this was not a true break of structure. We have those fake breakouts. If you ever heard of fake breakouts. So this we will learn this in the next topic, which is FTA. We will learn how to find fake breakouts. So those reasons may not make the price to react here in your formation. So aggressive, that's a risk of aggressive buyers. But if confirmation meaning you wait until the price tap the area, then gives you another conditions, which is change of character and break of structure.
Okay.
So confirmation is very important for those people, for those traders who they have low capital and trying to raise the capital. It's very important to use confirmation to be assured of what you are of the decision in the market. But aggressive is very risky, but is very important sometimes because sometimes price does not give you confirmation. For example, the price can break here and price just come, take the entry and go. Does not gives you any confirmation. Sometimes this is due to news or some other fundamental factors.
Okay, sir.
So this is how we trade. So whenever you enter in the market, first of all, you have to know which time frame are you going to use. And you choose time frame due to what type of trading style you want. Are you going as intraday? Are you going as scalper? Are you going as a swing trader? After that, after choosing the time frame coordination, then you have to know, after refining that area, you have to know, are you entering as a confirmation or aggressive? Those are very, very important questions to ask yourself before executing trades.
Okay.
Okay, so we are going to do some examples. We're going to do some examples so that you can see how we take this trade. This session is going to be over soon, so I will send another link so that you can have more examples.
Okay, sir.
All right, so the first example is the entry I took in GBP USD. It was a very, very simple trade. I took 3 entries in this week, in this last week, in GBP USD. The first entry was here. So this was our, I used a 4-hour time frame. In the 4-hour time frame, as my constant time frame, because I'm an intraday, I found this was a break of structure there. See? So after that break of structure, the price left us with a different formation. This was the formation. Actually, this was this is what, if you remember, this was what happened now? Sorry, I don't know what's happened today. Hello, can you hear me?
Yes, sir.
All right, so after this break of structure, price left us with different formation. This was our candlestick and atom, but also price left us this formation down below here. So I marked this formation here. Now, before that, of course. So after this formation, I'm now trying to refine, because from here, from this point here to here, it's very risky. 18 pips. I cannot lose that amount of risk. So I go now from 4-hour, I go to 30 minutes to refine that area. Now, in the 30 minutes, I found now we had this formation, but this formation was already tapped by this candle here. As you can see, this candle brought a wick and consumed this area of liquidity. So I had to find another entry. I mean, another formation. Another formation was here. Now I cannot lose now this amount of risks. So I go again in the lower time frame, which is 5 minutes, to refine that area. Now you can find this is a formation here. If you go back now, we are now in the universal time frames. So we go to 3 minutes time frame to see if the price left us with anything, and you can find we have this what is this? This is the liquidity engineering.
Yes, sir.
Let's see in the 1 minute if we have anything. In the 1 minute, we have nothing. And actually, we have this as our liquidity engineering. So we can take our entries from there. And if we measure the pips from there to here, we only have 12 pips. See? So if you go back now to our 4-hour constant time frame, so this is my entry. This is my stop loss. So let's play price here. So the price came and took the entry and moved. So this is where this is if I use aggressive buyers to take entry. But if I use confirmation, meaning I will wait for the price to tap my area, then I go to the lower time frame, which is 30 minutes, to find the confirmation of this entry. So if we go back to the 30 minutes now, look what the price offers. The price changed the character here because this was our swing point. The price changed character and then did what? Break structure.
Yes,
So
sir.
this is the strong shift. You see?
Yes, sir. Yeah.
So after the price performed this action here,